German manufacturing, the locomotive of Europe's largest economy, is running out of steam 3 years into the Eurozone debt crisis, which has clotted orders and output. Data on Wednesday showed output slid by 1.8% on the month in September, more than forecast and the sharpest drop since April. The day earlier, data had shown industrial orders fell 3.3% month-on-month in September. Economic advisors to the government, traditionally known as the wise men, said Germany's economy would probably hit a low point this quarter and grow just 0.8% this year and next, mirroring forecasts published by the European Commission on Wednesday. "What's really worrying is the economic development next year," said advisor Lars Feld after the panel handed its annual report to Chancellor Angela Merkel. "The downside risks to our forecast look greater than the upside ones, given current data." Industry accounts for a third of German gross domestic product (GDP). Other recent data has shown business sentiment worsening, the private sector contracting, joblessness rising and industrial orders falling at their sharpest rate in a year, though consumer morale has held up and exports have leapt. Germany has so far been largely insulated from some of the difficulties elsewhere in the euro area. But the latest data suggests that these developments are now starting to affect the German economy, European Central Bank President Mario Draghi said at an industry event in Frankfurt on Wednesday. While Germany's economy long fended off the Eurozone's troubles, expanding by 4.2% in 2010 and 3% last year, growth slowed to 0.3% in the second quarter of this year from 0.5% in the first, and some economists expect the contraction in the fourth quarter. The Eurozone crisis is hitting the domestic economy. German companies seem to be less and less inclined to invest, and that points to the economy contracting in the fourth quarter, said Stefan Scaldi at HSBC Trinkas. Winter gloom. The German economy should regain some momentum in the course of 2013, largely due to an economic recovery beyond the Eurozone, but in the coming months economic data is more likely to be disappointing, he added. The panel of advisors said that while Germany may have managed to consolidate its budget well this year, the darkening outlook means it cannot rely indefinitely on strong tax revenues and special factors such as low interest on debt. It will also have to contend with rising spending in the future due to an aging population, they said. Wednesday's economy ministry data showed factories churned out 2.2% fewer intermediate goods and 3.5% fewer capital goods on a monthly basis since September, dragging overall output down. Activity in the construction sector, which rose by 2.7% on the month, was the only bright spot. The ministry said industrial production in the fourth quarter would be weighed down by weak order levels, with the various industrial survey indicators pointing to steeper falls in production ahead. Germany's growth engine is still sputtering, if not in reverse, said Jonathan Loynes, chief European economist at Capital Economics. Industrial companies have taken a knock recently, with German steelmaker Salzgitter SZGG.D cutting its full-year outlook, and Continental Kong.D, Germany's biggest tire maker, said it would scale back some production as Europe's debt crisis sets demand. German industrial production has nonetheless fared much better than struggling Eurozone peers such as Spain, where industrial output fell by 7% on the year in September. In short, the German economy is stuttering but not yet plunging, said Karsten Piarczewski, senior economist at ING.